Bonds payable. Bonds payable are simply another means of borrowing money from others. Usually this will be borrowed from debt investors or other companies. Bonds payable increase when bonds are issued and they decrease when they pay off the bonds upon maturity. Or, if they are allowed to call the bonds, which means pay them off early, the bonds payable will decrease at that point in time. In this example, we started the period with $10,000 in bonds payable. Then let's assume during the period that the company issued 20 $1,000 bonds. That would be 20 times $1,000, assuming they issue at their face value. That would increase bonds payable by $20,000. As you can see here, this is a 20-year bond. So the due date when it matures is specified on the bond itself. The interest rate is 3.5% per year. So that will be 3.5% times $1,000 every year that will have to be paid in interest. On 20 bonds, that will be a total of $700 per year. If investors were to purchase these for $20,000, bonds payable would increase by $20,000 and the company's assets would increase by an equal $20,000. If Standard Electric chooses to pay off some bonds, it will decrease its bonds payable, resulting in an ending balance of $23,000. We have just completed a whirlwind tour of some common liability accounts. Liabilities are amounts that a company will have to pay or services they will have to render in the future as a result of some past transactions or events that obligated them to make those payments.